The U.S. economy has experienced a remarkable growth spurt, achieving an impressive annualized increase of 3.8% in the second quarter, exceeding earlier forecasts significantly. These findings were reported by the federal government, indicating a robust economic landscape despite the uncertainties created by President Donald Trump's tariff policies. As of September 25, 2025, this latest data suggests that the economic performance over the recent 3-month period has outstripped prior estimates, initially set at 3% and adjusted to 3.3%. The final figure of 3.8% showcases a sharp rebound following a contraction of negative 0.5% in the first quarter of 2025. While this growth is promising, it also places the overall economic trajectory of the first half of the year in a context of slowdown. A primary driver of this impressive growth has been an uptick in consumer spending, a vital component that constitutes approximately 2/3 of the economic activity in the United States. The U.S. Commerce Department highlighted that this surge in consumer expenditure has played a crucial role in lifting the economy during the 3 months leading up to June. Yet, the complexities introduced by Trump's tariffs have somewhat muddled the implications of these GDP findings. In calculating GDP, the government subtracts imports to focus on domestic production. Fluctuations in import levels can obscure the true health of the economy. Notably, in the first quarter, there was a significant increase in imports as businesses anticipated upcoming tariffs and stockpiled inventory. Following this trend, a noticeable decline in imports during the second quarter likely contributed to an inflated GDP figure, as the decreasing imports are counted as a subtraction in GDP calculations. This nuanced relationship between import levels and GDP figures can lead to misleading conclusions about economic strength or weakness. In another concerning development, recent employment reports reflect a stark downturn in hiring during August. This period of weak job growth has alarmed analysts, who caution that the economy could be edging closer to a recession. However, it's noteworthy that the U.S. economy has managed to evade the widespread job losses typically associated with economic downturns so far. Adding to the complexity, a revision of past job growth estimates revealed that the labor market added significantly fewer jobs throughout 2024 and early 2025 than initially reported. This news has increased apprehension regarding the overall health of the job market. In response to these challenges, the Federal Reserve has taken measures to stimulate hiring by lowering interest rates. The Federal Open Market Committee, FOMC, has signaled the potential for 2 more cuts of a 1/4 point over the remainder of 2025, which would be their first interest rate reductions in 9 months after a span of 5 meetings. As we digest this evolving economic landscape, the juxtaposition of strong GDP growth against a backdrop of declining job numbers raises critical questions. Are we witnessing a temporary surge that may not be sustainable? What are your thoughts on the effectiveness of the Federal Reserve's strategies in this context? Share your views in the comments.